In this video, we will discuss the power of diversification, its benefits, and if it's the optimal method to pass prop firms. Moreover, we will look at how looking for runs of winners may actually be a more effective method of passing prop firm challenges. So we can kick us off here looking at this slide, which looks at some of the basic principles of modern portfolio theory. So Mr. Markowitz won the Nobel Prize for coming up with this, so he was definitely a very smart cookie. But the effective premise behind it is it shows that creating a portfolio of different assets, or in this case, we can look at different trading strategies, enables you to have a significantly better risk-adjusted portfolio. And granted, this typically looks at a portfolio which is comprised of different assets, being like bonds and equities, but I think the premise can still be extrapolated over to different types of trading strategies. And in the concept of bots or EAs, you could perhaps look at this through a variety of different types of trading systems, be it mean reverting or trend following or breakout, which are trading different assets like gold or the US 30, so the Dow Jones, the SPX, currencies, etc. And effectively what this video will dive into a bit more in detail is when it comes to building a real portfolio with your own money. Modern portfolio theory is completely correct. You definitely should use diversification. This will massively reduce your drawdowns, significantly improve the consistency of your returns. And Kevin Davey, who's one of the most famous algo traders out there, has said that portfolio diversification is the closest thing to the holy grail that exists. And I would completely agree. And from my own experience, I have found this to be one of the best things that you can use for algorithmic trading. That being said, what about with prop firms? And with prop firms, I find that oftentimes diversification might not actually be the best approach. And this is because a run of winners may be the fastest way to pass prop firm challenges. And some of our clients here at Prosperity Algo have actually reached out to me in the past asking like, hey, can I run 4 or 5 different EAs in my account at the same time? And in reality, they may actually be significantly slowing down their progress simply because they are putting too many systems which are not related together. And they're almost using diversification against them in a prop firm setting. So let's dive into Excel so I can actually put some numbers to all of this and provide a little bit more context. But here we can see an equity curve, and this is combining a few different systems. So we have some which are trend following, and we have some which are more mean reverting in nature. All of these systems trade gold, so it's actually a great example of how even if you trade the same asset, you can still have phenomenal diversification just by changing up your time frames and changing up your strategies. So we have Missile, which is a trend following system based on impulse candles. Time Bomb is also a trend following breakout system based on the opening range breakout and the London breakout. Seeker is a mean reverting system, which is based on the rejection of an impulse candle, so almost like the mean reverting version of Missile. We have Grenade, which is the mean reverting version of Time Bomb, which is a rejection of the levels created by the opening range breakout or the levels created by the London breakout window, so the Asian highs and lows. And then we also have Boomerang, which here is actually a mean reverting version of our sniper system, which is effectively looking for rejections off of key levels. So it trades false breakouts. All of these systems are a little bit too in detail or in depth to go through in this video in particular, but the key takeaways from this slide or this workbook are that this equity curve looks this good because we're combining a variety of different counter-correlated systems. So this is actually just a 1-year back test where we're trading a $10,000 account and we're using a fixed lot size of 0.3 lots. So a reasonably modest amount of leverage. And as you can see here, we turned $10,000 into, I think we're a little bit over $30,000 here. So around a 300% return. And we've also had an extremely smooth equity curve with minimal drawdowns. So this really demonstrates the absolute power of diversification. And not to get too off topic, but we can now look at if we just isolate Missile here by itself. So this is just one of the different systems trading. As you can see, the drawdowns are definitely quite a bit more hefty. And this is simply because certain market regimes won't lend themselves as well to this system. And if, for instance, you enter a super choppy period where you have large impulses which immediately reverse and hit your stop loss, Missile won't do as well. But that's why if you combined it with, for instance, the Seeker system, which trades the rejection off of Missile effectively, the equity curve is 1,000,000 times smoother. But we're going to go a little bit more into detail here. Combining the two might not actually be optimal for passing prop firms because of the fact that you can still capitalize on these long runs to pass prop firm challenges. And to illustrate my point here, let's look at the profits on a day-by-day basis if we compare all of the systems versus Missile by itself. So here we can see that this is the like just a pivot table where we look at the P&L of all of the portfolios, so the mixed EAs together, and we look at the profit and loss on a day-by-day basis, as well as the percentage of winning days and losing days. So here we can see that through this 1 year back test, around 67% of the days we won and 33% of the days we lost. And our average winning day was quite a bit higher than our average losing day, with $196 on the average winner versus around $154 on the average loser. And this is visualized here in this bar chart. And as you can see, diversification has given us like a phenomenal expected value figures. So not only is our win rate on a day-by-day basis really good, our risk reward is also really good. So super powerful. However, if we go over to Missile, and Missile is a phenomenal system, by the way, so don't take this out of context, we actually have more winning days. So 73% of the days we win versus 67. Moreover, with Missile, we also have, however, with Missile, our average winning day is quite a bit less than our average losing day. And this makes total sense because it's an inverse risk-reward system where when you have a loss, you will lose more than when you win. And you can see how that's reflected here in this graph. As you can see, when we have losing days, they're quite a bit more hefty relative to the winning days. Versus if we go back to this graph, the winning days are like enormous compared to the losing days. We have a few like enormous outliers here. However, and to kind of go back to the point of this video, with Missile, you can have these periods where you have effectively no losers and just large runs of winners. Whereas if you were to come here, back to a diversified portfolio, quite often, like yes, there are exceptions, but quite often you have losers which kind of get sprinkled throughout. Simply because if you're trading so many systems, you're bound to enter a market regime where some of those systems will take losses. The point of diversification is that if you're in a bad market regime for a particular system, the other ones will effectively compensate for it. However, let's say you don't really care about that because you just care about passing a prop firm challenge. Using one bot which only does well, or not only does well, but does particularly well in a certain market regime might actually be faster because you can capitalize on the winning streaks. So I'm sure I'm being relatively confusing here, but perhaps this one graph of Missile running live can actually illustrate my point. So unlike a diversified portfolio, when you're running a single high win rate bot, you can effectively have these super long stretches of winners. So here, 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 where you have rapid growth in the equity curve of one particular system. And because of this, you're able to essentially use this to pass prop firm challenges faster. So to kind of wrap up here, because in particular with prop firms, you're limited on your daily drawdown risk, and because you might not have a huge portfolio of EAs, and because you can capitalize on winning streaks, in the case of prop firm challenges specifically, using one or two systems which tend to trade a fairly similar manner can actually be relatively effective relative to a super diversified portfolio, which would be infinitely superior in a true your own money context. So maybe just to wrap up this video, I would encourage you guys to head over to our WAP page, which is linked in the description, to try out our past prop firms bundle, which is tailored specifically to use these long win rate runs to past prop firms. So I hope you guys enjoyed this video, and please leave me a comment if you have any questions, as it was quite an in-depth one. Take care, have a great day.